Hello, my name is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for November 9th, 2020. Please see our disclaimer for important information. Well, in our conversation this week, we have passed the election, so we have a presumptive president-elect. We know that there are going to be challenges to that. We don't quite know how long it's going to take. It seems like some of the challenges to date have kind of fallen flat on their face in certain jurisdictions with vote counting and things like that. In fact, my understanding from having read some information here over the last day or so is that there have been 5 challenges and all have been tossed to date. So, but in any case, we know that there's going to be a little bit of noise related to the election before the winner can be, I guess, certified, if you will. But having said that, we feel very confident now that Joe Biden will be the president, the 46th president of the United States. And we can begin to kind of shape our thinking around what that looks like. And I think, I want to put some notes together perhaps this week, and then in Market Minutes next week, we can kind of go through a more holistic analysis on what the implications are for a Biden presidency now that appears to be the case. But having said that, we had a pretty strong stock rally last week. And we're getting some good news on the vaccine front. Pfizer was out yesterday, and the market rallied in a very, very big way. But we do have virus cases rising in many areas of the world. We do have some economic activity that's slowing. I think the big question is, what extent will ongoing pandemic limit our economic activity? And there's just a lot of unknowns, and I don't mean to throw cold water on this robust week that we had in the equity markets, but because there are positive elements of this. We saw positive news on the vaccine front, which obviously added, it was like throwing gasoline on a lit fire. But we're still months away from a vaccine of any sort being widely available. And I also want to caution too, in reading the comments about that Pfizer report, that it was not a wide scale, even though there was 90% efficacy of the drug in question, of the therapy in question. It was applied to 94 patients in the sample size. So again, I think this is we're constricting this vaccine development in a time frame that is unprecedented, and I think there's just some things that we can't anticipate along the way, and it's still going to take a while. But really, where we sit now, equity and credit markets are really pricing in a return to pre-pandemic levels by the end of this next year. And, it could happen, but, the economy is going to continue to expand, I believe, but perhaps not at the pace that some people expect. And that outlook may be a little bit overly optimistic, just because of some of the delays. And it's still going to require a vaccine widely acceptable to get back to that economic growth. And I think there'll be puts and takes, and maybe a little bit of chop between now and then. The market being so strong, I still think that there's a little bit of vulnerability to near-term setbacks. And again, not that it's going to inspire a wholesale change in volatility, but I think we certainly have the capability of having corrections here and there, and I think we're going to have to get used to the notion of having 1+% movement days in the equity markets and wide changes in fixed income and in the treasury markets. But in any case, let's kind of dig into some of these numbers. Last week, the Dow was up 6.9%, S&P was up 7.3%. NASDAQ was up 9%, and it's the best week that we've seen since April. According to Barron's, it was the best election week that we've had since 1932. There are some things that we do know about about the election. Some things that have yet to play themselves out. That blue wave that I think was hinted strongly at, it failed to materialize. And even though we've got 2 runoff races in Georgia coming up in January, which could determine the fate of the Senate, it seems to be the opinion of the majority now that it's going to be difficult. It might be like a 51-49 GOP majority. So even with the tie-breaking vote from the vice president, assuming that Joe Biden is our president, that still would not result in a Senate majority for the Democrats. So, and Democrats actually lost House seats as well. So, but with that, it was a very interesting week. In some respects, not expected, but in any case, looking at earnings were, for the third quarter about 20% higher than analysts predicted, even though they're still down about 10% year over year. Sales were above expectations as well. Again, these estimates were managed down, but it's still psychologically imperative that you have these beats, and it instills investor confidence. And then just looking at other things from Barron's, cash acquisitions were up 45% during the first half of the year, and research and development expenses increased 10%. We actually had a rise in dividends, so a lot of companies that had curbed their dividend payments earlier this year in the face of the pandemic are beginning to increase those now. But we had strong performance in the tech sector, and then government bonds, as I mentioned, had a wild swing. The 10-year ended the week at 82 basis points, or 0.82%, but it was a whipsaw, at least 20 basis points in there. And we'll talk about the implications and what this read-through kind of means for us, perhaps, but related to split government and the implications of that in terms of maybe lower fiscal stimulus and what are the ramifications there. But we had a rise in crude prices, which rebounded from their worst week since June. They were up almost 4%, and then we had basically some pretty good economic data on balance. Let's see, we had the jobs report. We added 638,000 jobs in October, and that was well above the consensus. And then we had really gains across most of the economy. The unemployment rate also fell to 6.9%, and then we're also seeing some continued traction in continuing claims, which is good. The Institute for Supply Management Manufacturing Index was up to 59.3, and it was close to the 2018 high. I mean, well above even pre-pandemic levels, which is really good. Non-manufacturing, which we've noted as having been a laggard in the pandemic, essentially the non-manufacturing equal service, but that was still at 56.6, which this being a diffusion index means that any reading above 50 indicates expansion in that area. So we're seeing expansion in services, which is really good. It's a sign the business outlook is a bit more positive than it was. So some really positive things amidst some of this other noise, which I would certainly take as encouraging. Looking at the equity markets and the markets in general year to date, S&P is up about 8%, 8.6. Dow's down slightly. NASDAQ is up quite a bit, with the tech stocks having led that market. You look at Europe, is down roughly 8%, and the EFA, which is kind of the index most commonly used as a proxy for international stocks, is down about 5.5% for the year. Emerging markets are up about 5.5%. Bonds are up about 6.8, and then, as I mentioned, crude, which is still down almost 40% for the year, is up almost 4% for the month. And then, we've talked about the dollar being down lower. Dollar lost traction so far this month, and for the quarter, it's down almost 2%. For the year, the dollar is down about 4.3%. So, in our charts of the week, we've got some information on the dollar that I think is helpful if you would turn your attention to that. But weaker dollar tends to be better for commodities, tends to be better for stocks, tends to be better for emerging markets, and so we'll continue to watch that. All right, so now the divided government, if this materializes and the Senate goes to the GOP, the market likes that more likely. You have, I think a less of a probability of having a large tax increase. You have less of a probability of, frankly, having a huge fiscal stimulus program, because right now the GOP is adamant, and Mitch McConnell is adamant about not having any stimulus program that's over $1 trillion, which is a mere fraction of what the Democrats in the House want. And so what, the implications there are, you get less stimulus, maybe less inflation impetus from that. Maybe you get lower interest rates because of lower inflation expectations. I think what this could do actually is it could inspire the Fed to become more activist in a way. And right now they're a lender, not an investor. But with lower fiscal stimulus, and we know that there's impacts to the economy, we know the struggles of small business, we know that there needs to be some type of stimulus done, and we're confident we're going to get that. It's just how much, and if it's viewed as not enough, then you could have a more more active Fed that you could look at this in a lot of different ways, frankly. You could have the Fed could get more involved in maybe loosening restrictions on their Main Street program and their facility that's created for municipalities to borrow against. They could signal that they're going to leave interest rates lower for longer, and they're already essentially expectations are for short-term rates to remain near zero through at least 2023. So, but a divided government is unlikely essentially to create a large stimulus package. And we've got 11.6 million people unemployed, and a lot of those are long-term unemployed. We've had some destruction overall in net jobs, but I think, like I said, the Fed could be more aggressive in some of these areas, and maybe develop perhaps some creative lending programs, which could be viewed as being expansionary, enough of that. But let's see. We talked about the jobs report, and we talked about the ISM number. Both were good, although on the jobs report we continue to lose government jobs. We were down about 270,000 government jobs last month. And I mentioned unemployment was down to 6.9 from 7.9, which is a sixth straight decline. So, the optics of that are very positive. Participation rate was 61.7. Yeah, not too close, or excuse me, not too far from recent levels. But, I think, so anyway, just talking about some of these implications for, for the market and for the economy, and kind of what could sow the seeds of uncertainty here in the days and months ahead. With Biden's victory, let's face it, there's still a lot of economic distress out there. So I think it's hard to imagine that he would even try, perhaps, to instill a lot of tax increases. There are some that I think he's going to push for, but with a divided government, I would say it might be hard to get that done. But, there's economic distress. Obviously, we're in the middle of a pandemic, and international relations are really, really fractured right now. And with a divided government, I think, you really don't see a whole lot of interest on the part of the GOP to compromise. And in fact, they gained House in the seats, like I said. So I think in that some respects that might embolden the GOP to not work with the incoming president. And so essentially, there is not going to be a kind of a honeymoon phase for Joe Biden. There's going to be trouble with his nominations. Obviously, we've got to we have to probably expect trouble with international agreements and things like that. You can't just turn those things around on a dime. And then, frankly, Joe's got some dissent within his own party. You've got your extremists on the far left, and you've got the moderates that struggle with that, and then you've got other folks that just don't like Trump. So anyway, it's gonna present some challenges on the outset, and we'll just have to see how all that works out. So evaluation, we're still looking at stocks. As being, I had a chart in Charts of the Week that actually showed that the valuation of the 495 stocks in the S&P 500 index that are not technology, if you take out the top 5, the PE ratio, even with this move, is not onerous. It's 17.5, or maybe it's slightly higher, and the average long term is just over 16. So I found that really interesting in the analysis. In the aggregate, if you add those top 5 stocks, the index is up close to 20 times. But again, we've got low rates. Investors are starved for growth. I think we have expectations for earnings growth next year. Now, there's again a lot of optimism built into 2021 right now, and but I think if you look at it over a long term, it does paint a fairly reasonable picture for stocks, and so I'm encouraged by some of this. Obviously, we could have setbacks in the vaccine as well as in the economy, but I think, given that we're past the election now, I think what it lays the groundwork for, especially with this divided government prospect, and taking this massive stimulus program potentially off the table, it actually sets a better backdrop for investments. And so we'll be monitoring that. But I think with that, we'll kind of wrap with some of these themes and some of these, kind of put my observations together, and I can kind of condense it into a few things. One thing, first of all, what we've seen, we haven't really talked about it that much lately, is China. China's economy continues to improve, and didn't get a lot of press because of the election, but the Chinese Central Party actually met to chart out their 5-year plan for economic and social goals, and I think they recognize that the U.S., regardless of who's sitting in the White House, is going to want to curb their ambitions, and China, frankly, is continuing to try to find a way to move away from a manufacturing-led economy and get more interest in consumer demand. So that will be something in 2021 that will be I think a major theme as the U.S. tries to get itself back on track and recover some of that loss or that part of the economy that was destroyed in the pandemic. Corporate earnings, I think, are really interesting because companies I think have gotten the message, trying to be leaner, even though corporate borrowings and net debt issuance as a percent of GDP is way off the charts. I think we could, if the economy continues to improve, I think the threat of a major default wave kind of goes away. But you can see corporate earnings begin to migrate higher, which is really positive for the health of the market. And so I'm encouraged by that. Obviously, monetary policy, we talked about what the Fed may do. I honestly do think the Fed is going to feel the pressure to remain really accommodative and maybe even step up further with asset purchases and, again, reduced restrictions on some of their lending facilities. So I do think that we're going to see a very accommodative Fed that, again, it's good for investments. Manufacturing data, I talked about that, very strong, highest level in 2 years. Who'd have thunk that, right? job market. We had a little bit of a stall, and but we seem to have picked up a little bit of momentum, and then we've got a couple of issues related to the election. I think what's clear is that Joe Biden and Mitch McConnell have a lot of working experience. I think both of them have been tied to the Senate or in government for 35 years or so, maybe not quite that long, but for many, many years. And so I think the opportunity to have them work together on things is you don't see a whole lot of that these days. I mean, maybe it doesn't materialize, but I think we can all have hope. And then finally, this divided government thing that I keep coming back to. I think it's proven itself time and time again to actually be conducive to investments what am I trying to say? That basically are going to lay the foundation for financial plans of our clients for the future. And I'm very optimistic over the long haul. I'm more optimistic over the short term than I have been in recent months. We still have challenges with the pandemic. We still have a high rate of infections, albeit a low death rate. We're obviously going to have to get our arms around that. And there's still obviously some worries in the cold season, cold and flu season, that those numbers might become a bit more troublesome. But I have greater confidence in our ability to tackle those types of things now than I did several months ago. So again, I think it just lays a backdrop. If we can all have the visibility of looking out, perhaps another 12 to 18 months, that we'll be in a much better place economically than we are today. And with that, I will conclude today, and I hope you've enjoyed the commentary, and wish you a very happy and a very safe week as we approach the holiday season and Thanksgiving. We'll be back with you next week for another edition of Market Minutes. Today, certainly encourage you, if you have questions, comments, to look at the information on your screen, send us a note. We'd love to hear from you. Have a great week, and we'll talk to you again soon.